Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. Today, I'm joined by Phil Huber, author of the new book, The Allocator's Edge, A Modern Guide to Alternative Investments and the Future of Diversification. In addition to being a best-selling author, Phil is the CIO of Savant Wealth Management and has been named to Investopedia's top 100 financial advisors a number of years running. Welcome to the show, sir.
Thank you so much, Daniel. I'm not sure what to call you these days because your Twitter handle always changes with the season. So I got used to Crosboo, and now I think it's Crosmiss. And so I didn't catch if there was a Thanksgiving one. I missed you over that week, but it's always fun to see that change.
Yeah, I took about 6 to 8 weeks off of Twitter, and it's the most,
which is healthy to do from time to time.
Why? Let's do a podcast about this. I was so happy and well-adjusted. I mean, relative to me, right? As well-adjusted as I ever am. I was so happy for that 2 months. And then I'm back as of a day or two ago. And it's like I'm back hooked again. So why do we love this thing that's so bad for us? However, it did lead us to meet. And that's how I got to know lots of great people like you. And it's how I've come across a ton of great content like your book. So congratulations on the launch. We talked before the show. You've been on a number, you're doing the rounds. You've been on a number of big shows and it seems to be really well received so far.
Well, thank you. I appreciate that. And it's great to be here with another Harriman House author, multiple time Harriman House author. So we've been through the same process with the same group and lived to tell the tale. So it's been a fun ride to get to this point. I'm happy the hard part's behind me, and now it's fun to just kind of have it out there in the world and be able to share it with people.
Yeah, can't say enough good stuff about Harriman House. Not only are they great at their jobs and a pleasure to work with, their holiday baskets are absolutely unparalleled.
It's funny. I just got that a couple of days ago, and it was a nice, pleasant surprise in the mail. But no, yeah, that gave me a lot of comfort to proceed with them. Was talking to folks like you and Brian Portnoy, because I wasn't shopping my book around publisher to publisher. Like it initiated with contact from Harriman years ago, just to kind of gauge interest in the book itself. We didn't even have a topic at the time. It was more just kind of, hey, like, is there an interest here? And so I just took comfort knowing that everyone I talked to that had worked with them had such a great experience, and they're such a great, small team, but a great team, and they were a lot of fun and really helpful.
Absolutely. Well, let's jump into the book now. You have a foreword by a very heavy hitter. Cliff Asness did the foreword to your book. The foreword is actually a great read. I got to admit, I almost never read a foreword. I kind of skip to the meat, but when I saw that Cliff wrote your foreword, I knew I had to read it. It did not disappoint. So both you and Cliff begin the book with a critique of sort of the traditional 60-40 portfolio. And your critique is based on a number of grounds. You have some great information on diminishing yields of a 60-40 portfolio, increased correlation between stock and bond markets, and expectations for lower than average expected returns. Can you take us briefly through why you think each of these arguments hold up and why you think a format that has served investors so well for so long and so cheaply is no longer perhaps the way to go?
Yeah, I think, first of all, I was so honored that Cliff was willing to contribute the foreword to the book, and he did an incredible job. I remember getting the draft from him and just reading it through, and I was just like, I don't think there's a single edit to make to this. And then Craig, the editor, agreed. Like, it's perfect as is. It was awesome. And if you know Cliff, you got to read the footnotes too. But yeah, he touched on that in his section, and then the whole first chapter of the book is on this notion of what we call, like, hindsight is 60-40 is the title of the chapter. And I think it's easy to understand why advisors and investors are so anchored to this kind of classic balanced portfolio of 60% stocks, 40% bonds. Because, as you pointed out, it's served investors incredibly well over the last few decades, and can be implemented extremely cheaply and efficiently. And it's also very easy to understand and grasp. I think most, investors that advisors sit down with very much understand that the core kind of building block asset classes of stocks and bonds. So there's a very much an intuitiveness to it. Like, oh, I've got my stocks for growth and offense and bonds for kind of stability and income and defense, and they can diversify each other, and it creates balance in a portfolio. And you can own the market in both these categories very cheaply, et cetera, et cetera. And oh, by the way, it's happened to do tremendously well over the last 20 years, and in particular the last 5 to 10, as we've had a pretty extended equity bull market. And so very much understandable as to why that's become, in many ways, sort of the default for a lot of folks. But the challenge is future returns don't necessarily have to look like recent returns. And as investors, we have this is as well as anybody, given your behavioral credentials, is this kind of recency bias and anchoring bias that we exhibit. And so I think it becomes very natural to extrapolate what has been occurring into the future. But unfortunately, the math of expected returns doesn't look too favorable for that sort of simple blend, despite its intuitiveness and easiness to implement, particularly for the bond portion, the 40. The math of starting yields is a pretty good indicator of what you can expect from a total return standpoint over the next, call it 5 to 10 years. Not exactly, but it probably is going to explain 90+% of the return you're going to get in that part of the portfolio. And right now, if you're just thinking of kind of core, fixed income investment grade, you're probably looking at 1.5 to 2% there, and that's before the effects of inflation. So, that's one piece of it. The other piece, which again, this can be a bit more variable over time, which is the valuation of the stock market. That'll ebb and flow over time. And obviously, we know from history that valuation is a very, very poor timing indicator. It doesn't tell you really anything about the next 12 months, 18 months, 24 months, but decent relationship with explaining longer term returns. In other words, high current valuations tend to forbear lower expected equity market returns and vice versa. And particularly for kind of market cap weighted indexes and the U.S. stock market specifically, depending on your favorite valuation metric, we're looking at pretty, expensive stock markets. Now, some of that might be justified by the fact that rates are so low, and that can be a kind of a tailwind for valuations and justify paying a premium versus, other parts of history. But I think just the nature of that combination of high stock market valuations and low bond yields is kind of a cocktail for low expected returns for that blended 60-40 portfolio. And if you rank both those together, I think you're definitely in the top 10 percentile of history of expensiveness for that type of portfolio. So again, this is not the first time that anybody has been proclaiming like the death of 60-40. That's been a common, a refrain for several years now, and it just goes to show you how humble we need to be about, our ability to forecast the future, particularly in the short term, because it's definitely continued to work well despite everyone proclaiming that its immediate death was on the horizon. But at the same time, I think there needs to be an honestness and a soberness about those expected returns, and that at some point that eventually those will come to bear, and that advisors need to be a bit more open-minded going forward to kind of broadening the toolkit and opening up their portfolios to other types of asset classes and strategies that can potentially provide for higher expected returns and offer additional diversification, where perhaps in the future, especially if we get a prolonged period of high and rising inflation, which we know can be the kind of variable that can spell trouble for both stocks and bonds at the same time and disrupt that relationship where we tend to expect low correlation between the two. But if you get that high and rising inflation, that might cause those both to go up a little bit. So I think there's a much broader toolkit that we have to build portfolios with today as allocators. And so that's really the kind of genesis and inspiration for the book, is exploring that kind of broad nebulous concept of alternative investments. Like, what does that mean, and what's included in there, and kind of what is the what, why, how, and what behind investing in that category.
Yeah, so I want to pick up on a couple of things you just said there. You rightly stated that investors are anchored to the recent past, and they're sort of projecting the events of the recent past into the future indefinitely. And so one of the most illuminating graphs in the book was a table that showed the difference in various countries in the world between the expectations, the forward return expectations of professional investors and advisors versus those of retail investors. And I knew it was bad. Meb Faber talks about this a lot. He sort of pounds the table on this a lot. But it was incredible to see it laid all out in one place. And the average delta between those groups is 113%. So it sort of brings...
we should say that's in relative terms, not absolute. That'd be even more impressive if it was
yes.
113% absolute. Difference.
Yes. That is in relative terms. Good catch there. So it brings me to this weird place though, because on the one hand, I'm like, well, we have to educate investors about this sort of low return environment, because if happiness, right, if satisfaction is sort of expectations minus reality, we're going to have a lot of dissatisfied investors in the years to come, and that will lead them to be disgruntled with their advice and sort of perhaps behave in ways we don't want them to. But then on the other hand, you and I, you just talked about the difficulty of forecasting. I've talked about it before. I wrote an article 9.5 years ago talking about how high valuations were at the time. And I just cringe when I look at it, because valuations have been so high for so long, and focusing on that has been the wrong move. So what do we do with this crossroads, right? We know that things are steeply valued in some respects. We know that the 60-40 may have some trouble, but we also, I think, have, as an industry, scared people out of positions that they maybe should have held on to at various times. So how do you think about educating folks about this potential for a low return environment going forward?
I think, first of all, it goes to show you that even when you think things are crazy, sometimes it can always get crazier, as we've witnessed. And I think it speaks to why you want to think probabilistically when you're making allocation decisions, and you never want to make kind of all in or all out decisions either. So I obviously the book is focused on alternative investments. Clearly I'm advocating for some meaningful allocation across a suite or an ensemble of different types of alternatives in the book. Otherwise I wouldn't have written it. That being said, I'm also not saying sell all your 40 or sell all your 60 and go 100% into alternatives. That's not the answer that comes out of the book. The idea is, hey, these core building blocks still have a valuable role they can play for investors, but perhaps less so than before. And there's just a wider spectrum of things that we have access to that maybe we didn't 10, 20 years ago. And so a wider amount of selection. Now, to that study that I referenced in the book on that gap between advisor expectations for future performance and individual investor expectations, there's a huge delta there. But it also shouldn't be surprising. Individual investors, for the most part, aren't sitting around studying base rates of historical stock returns and bond returns, and they're not, immersing themselves in all the decades of data we have on the expected returns of stocks and factors and best and worst outcomes over, different time horizons and things like that. So I think advisors tend to think about things, rightfully so, I think, more probabilistically and using base rates and things like that, which is a good thing. But individual investors are likely, going to come to their own expectations if we're not helping them set them. But they've also actually been more right than the advisors have in recent years. Not that will continue, but it kind of shows that there needs to be some humility built into the process. But we also don't want to confuse bad outcomes with a bad process. I think that's often a big mistake that investors, both professional and amateur, make. Is I have a great process and a well thought out decision, and it didn't work for me. And we say, we confuse that the outcome is what was, driving a bad decision, but that's not always the case. And so I think it is incumbent on the advisor to try to helpfully set thoughtful expectations, particularly around things like alternatives, where, I think often that's where there's been perhaps some bad experiences in the industry with alternatives, is not only, unmet expectations on the end client side, but I think advisors maybe didn't have a great way to figure out what should they expect when they're adding these things to the portfolio. There's so many different categories, and it's new to them. They haven't used these asset classes before, so they might not quite fully appreciate how long they need to give from a time horizon standpoint to let these things bear out, what they should consider the downside, potential to be, what types of environments should these different alternatives work in versus not work in, how should they fit into a portfolio, where should I be sourcing it from, all these decisions. I think it was very much a wild, wild west in the early 2010s following the GFC, when liquid alts first became a very popular category because, as we're known to do as investors, we have a big, huge event and we want to seek diversification after and not before.
Right.
Kind of shutting the barn door after the horses have already gotten out. And so there was a proliferation of product in the liquid alt space, and advisors very much wanted to access that. Probably at the time they should have been loading up more on stocks. So I think that was a time where there was a lot of misaligned expectations and some disappointed allocators because they didn't get the results they were quite hoping for in the backdrop of a long bull market in equities. And so it's kind of a fool me once, shame on you, fool me twice, shame on me sort of experience. And I think too, I think depending on where they carved it from, maybe they took it from stocks and were expecting stock-like returns with no correlation, or maybe they expected a sort of silver bullet type, allocation that's going to work in all market environments. So I think the more that advisors have educated themselves and continue to learn more about the inner workings of different alternative categories and how they fit into a portfolio, I think people are getting smarter about how to, incorporate them into their mix.
So you referred to this earlier today about just sort of how loaded the word alternatives has become, and you ran an extremely scientific Twitter survey. So you have a kind of a nice self-roast of the lack of scientific rigor with the study. But that said, I feel like some great sort of focus group type informal research on Twitter. And when you asked about the word alts on Twitter, you got responses, sort of a stream of consciousness. What word comes to your mind? You got responses like complexity, fees, opacity, illiquid, and even scam to describe alts. How would you define alts? And is this bad reputation deserved or not? And sort of where did it come from?
Sure. So, that's a very hard thing to do, is define what alternatives is, because all that word tells you is more about what something isn't as opposed to what something is. It's a broad catch-all term for essentially, anything that's not mainstream, or anything that, an investment, lexicon is not stocks, bonds, or cash. And so there's a lot that can fit in there, which makes it troubling. The challenge too, there's a couple other challenges. One, the definition's constantly evolving. Things that were maybe considered alternative 10 years ago eventually become more mainstream, and so they no longer are considered so. A few examples would be, publicly traded REITs, or high yield bonds, or emerging markets. Those were at one point very new asset classes and kind of novel areas for allocators to allocate to. Then they became more commonplace over time. So the definition changes, and that's also a little bit in the eye of the beholder too. I use this example of crypto. You ask maybe my grandpa about crypto, and he'll look at me like I have two heads. But when I talk to one of my cousins who's in their 20s, it's like they view the asset class right alongside stocks in their Robinhood account or something like that. So depending on your audience, or maybe a different generation, they might view things as very, very much traditional and just part of a diversified portfolio. Whereas for others, it's like, no, that's way too new and novel for me. So your audience matters. The definition is changing. It's very vague and kind of nebulous, the whole concept. So it is hard to unpack what alternatives means. There's a whole host of different asset classes and strategies, which I tried to get to as many of those different categories and different chapters of the book as I could. But it is tough, and so it's understandable when you have such a vague term. People's opinions of it are going to be very much colored by their prior experiences, and so when you throw out a open-ended question like that, like what's the first thing that comes to mind when I say the word alternatives, people are going to viscerally react to what's their experience been. Maybe it was a non-traded REIT that they couldn't get out of, from the early, or mid 2000s or something like that. And then that they viewed that as that was their alternative, and they had a bad experience there. So they're just going to swear off alternatives all, completely for the rest of their lives. And so I think you get some of that. It's usually kind of those negative reactions might be specific to one thing that's happened to them or someone they know with a certain category. So I don't think the bad reputation is deserved holistically, but in certain instances, yeah, of course it might be. But I don't think that individual instances should cause investors to swear off what could be a number of very valuable and evidence-based and things that they should consider owning in part of a diversified portfolio. They just have to think about it in the context of What are their goals? What is their tolerance for illiquidity or higher fee products? Because that is the nature of alternatives. They are higher fee than your kind of standard index, stock and bond investment. So that's probably a hurdle that a lot of index-based investors might need to get over, or might have a hard time getting over if they're evaluating alternatives just based on some of the headline, expenses. But I think that's even too general of a thing to say, oh, something's pricier that then I shouldn't consider owning it. I think there's a role in a portfolio for very cheap beta type stuff, and maybe being willing to pay a little bit of a premium for things that are more capacity constrained, more diversifying. If you still think you're going to get some value in excess of those additional fees, then it could still warrant an allocation. So yeah, I guess a long-winded way of saying it's hard to paint the category with a broad brush, but despite there being some deserved bad actors or bad reputations out there, there's also a lot of good there too that investors should consider.
If you could use just 2 or 3 criteria broadly to discern the kind of alts you'd be interested in investing in from those that you should steer clear of, what are some things that you would look at to try and discern between those two camps? Ones that could be legitimate diversifiers versus those who have earned some of the scorn that Twitter foisted upon them.
Yeah, we just talked about fees, and they're naturally going to be more expensive, but that doesn't necessarily mean you should buy a fund or a product at any cost. There's, I think Cliff has a good quote where he says, "No, there's no investment strategy so good that it can't be made bad by a too high of a gross fee." Mm-hmm. So I think, an allocator should still very much pay attention to expenses. It just shouldn't be the only sort of arbiter of this is good or this is bad. It needs to be a little bit more nuanced than that. But obviously, every dollar you're not paying in fees is a dollar that you're keeping. So that's one is you want to have reasonable, fair fees for that category relative to their peer group and relative to what you're hopefully getting in return and diversification benefits. I think there needs to be some sort of intuitive risk premium to why should you expect this strategy to make money over time? If you're going to plan on holding this for a long time, there's going to be short-term periods where it's going to be out of favor, like any asset class. So what's going to be the sort of narrative or story that's going to help you live through those difficult times, knowing that, hey, this too shall pass. I know that I should be compensated for bearing this risk over a long period of time. So whether it's a behavioral type of return premium or purely a sort of risk-based story, there needs to be a level of intuitiveness. Why should I expect to earn money in this over time? There should also be some element of just historical results, whether it's through indexes or the fund itself, where it has delivered. And I think just measuring how much of the underlying returns are actually just kind of beta, market beta masquerading as this uncorrelated return stream. There's many different subcategories within alternatives. Some have more equity or credit market beta and sensitivity than others. So just be clear, is the return I'm experiencing due to this sort of unique diversifying return stream, or is it really just, hey, this is a high fee product that's got some market beta and a rising tide is lifting all boats sort of thing. And I think too, not every diversifier or alternative is going to perform well reliably in equity downturns. But I think you want to, within your alternative suite, you want to have at least some exposure to asset classes that have some historical reliability of providing diversification when you want it most. It doesn't help too much when it's diversifying on the way up, but then on the way down, correlation spike to 1. So those are just a handful of things that you want to look for with alternatives. And then there's other categories that, maybe people tend to think of as alternative, but maybe when you're positioning them, if you're, something like private equity, it's not a true uncorrelated diversifier type alternative. But at the same time, there still could be a role for it in a portfolio. It just needs to be kind of configured and thought of properly as a component of a broader equity allocation. You might have it sit alongside your public stocks and say, hey, this is something I expect to broaden my, equity diversification given how large private markets have become, and hopefully given the illiquidity and time horizon and maybe some potential inefficiencies that exist in private markets relative to public, maybe there's an opportunity to generate some outperformance over that long period of time as well. So again, kind of a different objective for a different type of alternative.
Yeah, I love what you said there. The 3 things that I consider when looking at a factor and that I talked about in the behavioral investor were, one, sort of, is it intuitive, right? Is there a philosophical, sensible reason why this sort of makes sense to me? Two, is it reflected in the data historically, right? Has it outperformed? And then for me, of course, sitting where I sit, the third one was, does it have a behavioral component to it? Because I think that's what causes something to endure. But I loved your comments on fees and all the other things. I think that's a good rubric for considering, judging between the specific alts. One of the most valuable parts of the book, I thought, was part two, where you outline sort of the nitty gritty of a few different types of alternative investment strategies. Now, we're not going to go through them all here. We're trying to sell some books, my friend. We want people to go.
Yeah, we just want to whet the appetite.
Yeah, you got to whet the appetite. I made that mistake too often on podcasts, kind of giving away too many secrets. So talk about just one of those strategies that you think is perhaps underappreciated and warrants further attention from folks looking to invest in alts.
I would say one that comes to mind, this is one of my favorite diversifiers, is the category of catastrophe reinsurance, or insurance-linked securities. There's a whole chapter on that in the book. Only because when I think of like what makes for a compelling alternative, and for those unfamiliar, catastrophe reinsurance is something that's existed for centuries. There's a number of publicly traded reinsurance companies out there that have existed for 200 plus years, and so this is a long-standing business model that has a long history of profitability. And reinsurance is effectively the insurance for insurance companies, and I'm talking specifically about natural catastrophe risks, so things like hurricanes, earthquakes, wildfires, typhoons, etc. And the reason this is a compelling diversifier is there's an intuitive risk premium. If someone's buying insurance and someone's selling insurance, the person selling the insurance is not selling it at cost. They're selling it at cost plus an expected return premium because they're bearing risk. And in this case, that risk is a risk that is wholly different from financial market risk. It has nothing to do with, credit spreads or the 10-year treasury or inflation. It's you're bearing risk of unpredictable natural events that can cause a high degree of insurable damage. And so there's an intuitive risk premium, and it's a risk premium that's structurally uncorrelated with stocks and bonds. And there's a history of profitability in the reinsurance industry. And then more recently, since there is an index that tracks the catastrophe bond space, so there's a number of different types of insurance-linked securities that can allow for access to this asset class. The most common and most liquid is something called a catastrophe bond. And there's actually an index that has data, I think, going back to 2002 it's called the Swiss Re Global Cat Bond Index. And if you look at that, the historical results of that, you've had essentially minimal to no correlation with stocks and bonds, high single-digit returns, close to that of high-yield corporate bonds, lower volatility than stocks, and meaningful diversification. Like that's exactly what you hope and want for in a diversifier. And what's interesting today for allocators and investors is that there's actually a handful of 40 Act, registered investment products, whether it be mutual funds or less liquid interval funds, that you can actually, own this diversifying asset class in a portfolio relatively in a straightforward manner, where that wasn't the case, 10 plus years ago. That it was an asset class that the institutions were dabbling in, and there were some, hedge funds that were doing this sort of thing, either in dedicated vehicles or as part of kind of multi-strategy mandates. But this has been one of a handful of examples I reference in the book of something that I call old wine in new bottles, something that's existed for a long time, but is just now sort of being packaged in a more investor-friendly ways. So that to me, I mean, it's not again, like any alternative, it's not a panacea. There can be, rough years when you experience higher degree of natural catastrophic events that occur, but it's also an industry that responds dynamically to changing conditions, where these are typically contracts that reprice annually. And so, as you would expect, what happens when you're if your house burns down, hopefully it doesn't, but premiums go up. So when there's large scale natural disasters, the reinsurance and insurance industries have to respond in kind by raising premiums. So kind of one of those, like it's almost the same way in stocks. If you have a bad bear market and prices go down and valuations go down, your expected returns go up. Same goes for something like reinsurance. If there's a handful of bad loss years, those tend to be followed by a hardening of the insurance market and higher yields and prospectively higher expected returns. So something I would very much treat as a buy and hold long-term part of your allocation, not like a tactical sort of trade. But I think because it is more broadly accessible now, it's something that, if allocators aren't considering or haven't considered yet for their portfolios, definitely worth exploring, looking into.
Yeah, fascinating. Something I had never heard of until I read your book. And so hopefully lots of people will go buy the book and read about all the other types of investments that you cover there, because that one makes perfect sense to me. And it was one I was completely unfamiliar with. Another point that I thought was interesting in the book was that some of the historical dissatisfaction with alternatives may be down to people's sort of minuscule allocation to alternatives. They have heard about them perhaps at a conference or something. They knew they needed some. But you quote a stat in the book that said the average allocation to alternatives is about 4%, which isn't going to be, let's be honest, make a bit of difference in a portfolio over the long time. You're really not going to feel it. So how do you think about a percentage allocation to alts in light of everything we've talked about, and what does it take to sort of begin to see the difference?
Yeah, I mean, I think what you're referring to is spot on, in that, if you look at institutional allocations, the target alternative allocation within those, whether it be endowments or pensions or things like that, very much higher than your average advisor-driven portfolio. Typically in that 20 to 40% range, and definitely an emphasis on illiquid alternatives. But if you look at the average advisor type of portfolio, you get those low to mid single digit allocations to alternatives. And even if you look under the hood, like what are they actually allocating to? I mean, if it's something like REITs that some view as an alternative, there's a lot of stock market beta and risk inside of that. So even under the hood, it might not be as diversifying as they think. But to me, like something that's like 3 to 5%, at the end of the day, that's really just checking a box and like, oh yes, we have alternatives in the portfolio. It's not really making an impact. It's not really making a difference. So I think you're almost better off just staying at zero if you're going to do low single digits, because it's not moving the needle enough. I think where it's going to start to make a difference, I think there's a sweet spot you can find where it's enough to matter, but it's not so much that it's going to overwhelm the client experience and create these portfolios that look and behave so differently than what people are accustomed to or what they expect, that they're hard to stick with. And at the end of the day, the best portfolio is the one that someone can stick with. So I think there needs to be a mindfulness to that when advisors are constructing portfolios for clients. So in my experience, I would say that it's a pretty large range, but maybe anywhere from 10 to 30% on the kind of the high and low end. And some of that too, it can't, it's not just a blanket statement, because part of what has to be factored in is what are the alternatives being evaluated or considered, and where are they potentially being carved or sourced from? Stocks, bonds, combination of the two. So, those are all going to be, important factors to think about when you're thinking about sizing an alternatives allocation, in addition to the absolute, target itself.
Yeah. So no current discussion of alternatives would be complete without going into a couple of asset classes that have gone absolutely wild over the last few years. My last guest was talking about the market and trading cards, a fascinating conversation with Brad Johnson. Crypto and collectibles have really had a strong run for the past couple of years. Let's start with collectibles. There are now a number of tech vehicles by which you can become a fractional owner of whatever, an expensive bottle of wine, an old Lamborghini, a Jordan rookie, whatever it is you're trying to get a hold of. How do you think about things like wine, art, cards, cars as among the other alternative investment vehicles?
So yeah, first off, I'll say I was actually listening to that episode with Brad on the car this morning on my way into the office, and was really enjoying that. I think it's a really fascinating topic and category for me, because I mean, collecting is as old as the hills. People have always been looking for value and sort of scarce assets that have some sort of nostalgia component or aesthetic component, or just a shared affinity amongst a different community and cultural relevance and all these things. And so I think it's a really fascinating area. Like I'm very much have been following along the emergence of some of those technology platforms you mentioned, like folks like Rally and Otis and others, and Masterworks, where this new sort of novel way of owning collectibles, where instead of owning the entire asset, yourself and displaying it or putting it in storage somewhere. It's like this idea of securitizing and fractionalizing a particular valuable asset and allowing investors to participate in those categories at smaller dollar amounts and being able to build a diversified portfolio across things like trading cards and art and video games and rare wines and classic cars. I mean, just the sheer number of categories within collectibles has definitely exploded. And so to me, I view it as a sort of part of what I would bucket as probably part of what should be the speculative part of your portfolio, maybe the fun part of your portfolio. I think everyone can give themselves a little bit of an allowance to have some fun, and I've dabbled a little bit myself in a couple of those platforms just to experience it firsthand, and I think it's really neat that you're introducing an entirely new audience to some of these things that they might not have been able to participate in, if they're not a true ultra high net worth hobbyist type. And I think it's just, people gravitate towards the things that they're passionate about, whether it be sports related memorabilia or trading cards, or maybe it's video games is becoming another popular category. You're even seeing things like again, like technology is almost becoming like kind of a pop culture category where you see like sealed iPhones or the original iPod now it's a valuable type of collectible. So I think there's some cool stuff, but at the same time, like any sort of non-cash flowing asset where it's very much supply demand driven and can go through kind of boom bust cycles based on sentiment. Be thoughtful about how you size those types of allocations, and understand that there is a speculative component. But I think there seems to be a clear and growing trend there, and it would not surprise me at all if we saw a handful of like dedicated collectible based asset managers emerge, that you start to see some kind of pooled fund vehicles. Because if you think about the context of collectibles type markets versus something like U.S. large cap stocks, like I'm a big believer that particularly publicly traded stock markets are pretty darn efficient. Not a lot of alpha to be had these days. Whereas something like you never know, something like collectibles, where you might have a smaller subset of people that are really immersed in these spaces and might have some degree of edge, and particularly when you have a growing amount of retail participation that might not be quote unquote like smart money. Like it'll be interesting to see what the next decade holds for this category as it continues to grow and kind of more people on ramp into it. But yeah, for me, it's fun to watch. It's fun to dabble. It's a pretty modest, small amount of my own, personal portfolio, more for entertainment purposes. I do have a separate type of collectible that I enjoy more personally, that I actually do take possession of and display, and that's my childhood love for wrestling action figures that I've rekindled in the past year and a half. I think I was listening to that podcast you were talking about with Brad, and you mentioned, I think COVID did this to a lot of people. We were just stuck at home and we got nostalgic for our childhoods and went to our basements and dug up old stuff that was in boxes. And so that was something for me, as being a lifelong wrestling fan and collecting those things as a kid. My parents were moving houses, and they said, "Hey, take your box of stuff that we still have in the basement." And it was all my old childhood figures, and it just sparked these old memories. And I was like, the next thing I knew, I had a giant display in my basement, and I was on eBay and all this stuff. So that's been a lot of fun. I don't view that as an investment. For me, it's something I just take pleasure in having and holding and looking at and all that stuff. But I think there's a couple ways to think about collecting. Is it purely for an investment, financial reason, or is it more for personal enjoyment? And it could be a combination of the two, depending on what you're looking at. So yeah, I think it's been fun.
These things are certainly speculative, but I want to spend a minute with this idea of fun. I think that's an underrated utility when it comes to investing. So much of investing and saving money, psychologically, this is all perceived as a current loss, right? I mean, we know it's for our long-term good, and sort of in the back of our minds, we know that the dollar we save today will be worth $2 or $3 down the road, but it still hurts psychologically. It's no fun, to take that dollar you could have spent on a Hulk Hogan action figure and put it in the stock market instead is no fun. And so I do think there's some wisdom in carving a small allocation to things that you just find enjoyable. For me, it's baseball cards. For you, it's, whatever.
Yeah. And that's the fun thing, is like, I've got a handful of like figures that I keep like mint in box that I don't want to ever like take out of the package, because I think they'll be worth a lot more years from now, but at the same time, like I think there's a pretty low probability that I'm ever actually going to sell them. So it's kind of one of those things where if it doesn't bear out that this thing's, as valuable as I think it's going to be in 10, 20 years, worst case scenario, I just keep it and I enjoy still having it. So there's like a low, a low floor on it. So, and I think too, the other understated benefit is if you have, we all have limited attention and mind share that we can, spend on our portfolios. So if we're spending more time on the small, fun bucket that make or, even if it goes to zero, it's not going to make or break us. If that takes our attention away from the 90+% that's long-term, kind of more boring in a lot of ways, that we just systematically rules-based rebalance, let it grow, don't interrupt it unnecessarily, let it compound. If we can take our attention away from that and not let the bear markets and all the volatility that's going to eventually come, make us make bad decisions there, I think that's a good thing.
Yeah, in total agreement. Let that fun be sort of the catalyst for you eating your vegetables, right? But that's the wrestling figures and the baseball cards are dessert. But
yeah, it's the Reese's peanut butter cup after dinner.
That's right. Perfect. So let's talk for a second about crypto. This is, of course, becoming increasingly widespread, increasingly lindy, right, as it sticks around. Mm-hmm. How should folks think about, A, whether or not to invest in crypto at all? And then assuming they're interested, which crypto alts specifically to consider? Again, give us some rules for thinking about crypto in the same way that you gave us some rules for thinking about alts broadly.
Yeah, crypto is a little tougher because it is such a new, truly new asset class. Like it's a little bit different than some of the other technology-enabled things like collectibles and artwork, where they've been around for a long time. They're just technology is making them fractionalized and more accessible, whereas crypto literally came out of thin air in 2008, 2009, the genesis of Bitcoin. So as much as it's grown by leaps and bounds and is now, I think a lot of advisors have come to this realization in 2021, okay, this is not going away.
Right.
And I think that's been the common refrain I've heard of people that had some skepticism around crypto or have kind of come around and said, okay, I need to really start thinking more seriously about this and whether or not it makes sense to start, thinking about from an allocation standpoint for my clients, more and more. Again, that's what obviously high and rising prices will draw more attention and demand in. And that might ebb and flow if there's another, big correction or bear market in crypto. But there's also been, you mentioned that kind of Lindy effect. Like the more Bitcoin seems to get tested and other crypto seems to get tested by these, bear markets, and then it continues to trudge higher, only strengthens the case that there's staying power here. And so, there's been obviously a number of product developments in crypto in the past, year or two. Futures-based stuff, the sort of publicly traded trust type products that have premium and discount, considerations and issues with them, and some things that are higher fees. So I tend to fall in the camp that if you're going to make an allocation, your best bet is still to try to find a direct path to owning, the assets themselves, and not necessarily getting, inefficient or diluted exposure through, it might be easier to own some of these products on a Schwab statement or Schwab brokerage account or TD or what have you, but just because it's easier to get access to and more convenient, it might not be the best way to access it. So, I think that's only going to continue to develop, and you're seeing a number of platforms emerge that are focused on the wealth and RIA space that are looking to solve for that a little bit when it comes to direct ownership, thoughtful custody and safeguarding of assets, because I think those are some of the, sort of must-haves when advisors that are starting to think about the space seriously, they need to solve for. They want reasonable fees and costs, pure exposure, custody, security, all these things. Like those boxes need to be checked in order for a comfort level to be built. So, that's the one side. But when it comes to, thinking about it in the context of a portfolio, I don't have, there's no surprise, but there's extreme volatility. So not every, investor is equipped to stomach, if we think stocks are volatile. I mean, there's that old saying that a bad day or a bad year for bonds is a bad day for stocks. Well, you could probably say that a bad day for crypto is a bad year for stocks. And so, I think for investors that don't have a stomach for volatility like that maybe it's not for them. And I think we also need to be kind of humble about how do you think about expected returns for something like Bitcoin or Ethereum? Like these are, effectively teenagers when it comes to asset classes. They don't have they're harder to value. There's no real high degree of like cash flow, and there's not as much data that we have a lot more comfort in like the long-term return of stocks because we have hundreds of years of data supporting it. Whereas with crypto, like we're still kind of feeling around in the dark to some degree. And I think we'd be a little bit foolish to say, oh, well, Bitcoin returned this over the last 10 years. Let me extrapolate that same annualized return for the next 10 years. I think that's highly unlikely. So it's a little hard where, if you're asking me personally, I own crypto and as part of my portfolio. I'm a believer in it. Not everything necessarily, but I think particularly the kind of the blue chip coins like Bitcoin and ETH, I think are increasingly becoming compelling as playing a role in a portfolio. But I think, certainly they should be viewed as risk assets. They are highly volatile. So I would say when you're thinking about sizing those, a little bit can go a long way. And where you're taking them from, probably you want to take those from stocks when it comes to your starting allocation. So there's really not a good cookie cutter answer to every investor as to whether they should own it at all and what that allocation should look like. Some people are going to be more early adopters and kind of more frontier than others. But at the same time, there's still some, when you go beyond the kind of blue chip parts of crypto, there's some really compelling and interesting things going on, but there's also there's been some scams. There's been, when you're moving money around to different wallets and things like that, like you're going to hear more and more stories of people losing their keys or getting scammed and having all their stuff taken. And so I think, it'd be a little bit disingenuous for advisors to go too heavy and be too sort of, first mover in some parts of crypto to the detriment of their client experience. But at the same time, I think there is a growing case for, crypto for a certain audience of clients, and maybe that's a younger generation. Who knows? But clearly the refrain that advisors are hearing about this is not going away. I think that there's definitely some truth to that.
So you've given us a few glimpses into your personal portfolio. You've talked about your wrestling collection and your allocation to crypto, the two most interesting parts of your personal allocation. Nassim Taleb has this great idea that I wholeheartedly agree with. He says, you should never ask an allocator their opinion. You should only ask them to see their portfolio. So you have a young family. You're setting up yourself and your family for success in the future. Given everything that we've talked about here, how are you personally positioned? How are you incorporating alts into your own portfolio?
So right now, about 80% bonds, 20% stocks. Okay. No, I totally agree with you that I should be eating what I'm my own cooking here, and I definitely am. A lot of the categories I reference in the book have a place in my personal portfolio. That being said, I'm in my mid 30s. I've got a long time horizon and a high, I would say, generally a higher, risk tolerance than most. So my portfolio definitely tilts heavier to equities as I think it should. That exact number is going to vary depending on how I factor or treat a certain asset on my balance sheet, which is my ownership in my employer Savant, and prior to that, it was my equity in Huber Financial before we merged with Savant. And so, that's a big part of our sort of nest egg. And so I view that as a illiquid piece of private equity or a private company. So depending on if you're including that or not including that as part of the overall pie chart, if you will, that takes the alternatives percent that I have anywhere from like 15 to 25%, depending on how you sort of treat that asset. So a meaningful amount of my portfolio, call it 20%, in alternatives. All the same funds that we're using for clients at Savant, and then I've got some other categories that I allocate to as well. We've talked about things like crypto and collectibles. So yeah, I mean, as much as I understand the need for a large equity allocation, given my long time horizon and financial goals and return targets I want to hit, I'm also a big believer in diversification, and I think there's some compelling benefits to a lot of the things that I cover in the book in terms of how I incorporate them into my own portfolio. So there's actually, in the second to last chapter of the book, there is a section called How I Invest My Money. That was a very late addition to the book, and I'm glad I put it in there, where I really do go into detail, not necessarily at the individual fund level. I don't give like my exact holdings and tickers and anything like that, but I give a pretty good detailed kind of pie chart of what my sort of target allocation looks like across the different alternative categories, and a little bit of context and background as to why I do it the way that I do it. And that might not be this, that's not necessarily what's indicative that, anyone else should do. It's very much a personal decision, and that's what advisors can help clients, kind of navigate. But I thought it'd be silly for me to not to spend all this time writing about alternatives and not provide some context into what I'm doing personally in my own life. So I'm glad I added that in there. I think it provides puts a nice bow on that section.
Yeah, agreed. Well, Phil, it's a fantastic book. I learned a lot from reading it. It's incredibly sensible and middle of the road. And I think that's something that's missing in our industry. Your explanations are thorough and dispassionate, and I think that's what you want from this sort of book. So I hope everyone will check it out. If people want to buy the book, if they want to find out more about you and your work, where can folks go to do that?
There's a really great local bookshop called Bezos Bookstore, and by which I mean Amazon.com. That's probably going to be your best bet to find the book, both in hard copy format, ebook, audiobook, whatever format you prefer. It's going to be there, as well as other booksellers too, like Barnes and Noble. If you're interested at all in any sort of bulk order, please feel free to reach out to me directly, and I can set you up with my publisher and discuss pricing for bulk orders if there's an interest there. You can find me on Twitter at my handle @BipsandPieces. That's BPS and Pieces. And that is also the same name of my blog that I write at regularly called Bips and Pieces, and that's bipsandpieces.com. And then also savantwealth.com is my company's website, and I write there periodically as well. So that's generally where you can find me. And thank you, Daniel, so much for having me to come on and chat with you. It's been a lot of fun, and thanks for helping me share the story of the book.
Yeah, absolutely. My listeners will know that I think one of the most powerful things we can do as sort of a finance community is support people who are doing interesting new research like you've done with the book. So I hope that people will put their money where their mouth is and go support you. So thanks so much, Bill. Learned a ton, and best of luck with continued success with the book.
Thank you so much.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.